Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook. Welcome to the deep dive, everyone. I want you to imagine for a second that you are the chief financial officer of a major Japanese manufacturing company.
Oh boy. Yeah, that is a highly stressful job right now.
Right. I mean, it's early April. You are basically on the hook to publish your profit projections for the entire next year.
Hmm.
But there is a massive catch. The world's most critical shipping lane has, well, essentially turned into a geopolitical toll booth. Energy prices are fluctuating wildly, and the economic data you rely on to forecast U.S. demand, it might not even be published this week because of a U.S. government shutdown.
Yeah, which is just crazy to think about.
It really is. So how do you predict your profits in a complete vacuum? That
Mhm.
is the exact nightmare scenario facing the Japanese markets right now, and that is exactly what we are unpacking for you today.
It's a phenomenal question, and honestly, it's arguably the single biggest driver of institutional anxiety this week. We are dealing with this tangled web of, you know, geopolitical maneuvering, corporate earnings fears, and a truly unprecedented schedule of macroeconomic data.
Right.
And for you listening, it is vital that we strip away the political noise, like entirely. We are viewing all of these global figures and policy decisions strictly through the lens of market impact.
Exactly. No politics, just the raw mechanics of the market.
Right. We are looking for causality, like how a maneuver in the Middle East or a delayed spreadsheet in Washington ripples directly into Japanese equities and Forex.
Exactly. And to make sense of this massive influx of data, we have a clear roadmap for you. We are breaking this deep dive into 3 sections.
Okay.
Section 1 is this week's stock market outlook. Section 2 is key factors and the volatile Forex market. And finally, Section 3 is the weekly timetable. But instead of just reading you a calendar, we are going to group these catalysts by theme so you can see the colliding forces clearly.
Which is necessary because it is an incredibly heavy week. So understanding the mechanics behind these headlines is really going to be your best defense against all this volatility.
Absolutely. Okay, let's unpack this with Section 1. This week's stock market outlook. Broadly speaking, the overarching market sentiment feels like it is fundamentally morphing right now.
Yeah, morphing is a good word for it.
Right. Geopolitical fears are no longer just abstract anxieties. They are starting to materialize as tangible threats to corporate balance sheets.
Mm-hmm.
Like looking at the recent snapshot from our source, the Nikkei is sitting at 53,123.49, which is down about 249 points. The TOPX is at 3645.19, down 4.50.
Yeah, and those specific numbers reflect a market that is deeply unsettled by the situation in the Middle East.
Mhm.
But what is truly fascinating here, and we need to pay attention to this, is the distinct shift in what institutional investors are actually focusing on.
What do you mean? Like, what's changed?
Well, previously, the anxiety was purely chronological and event-driven, right?
Mhm.
The market just wanted to know when the U.S. military operations against Iran would end. It was all about the timeline of the conflict.
Okay, right. Just when does the shooting stop?
Exactly. But now, that real concern is shifting toward the midterm structural economic reality.
Okay.
Specifically, how are sustained elevated crude oil prices going to erode corporate earnings over the next 2 to 3 quarters?
You know, to use an analogy, it's like, well, it's like the market is shifting its gaze from the immediate lightning strike to calculating the long-term cost of the water damage.
I like that.
Right, like the lightning strike is the military action, it's loud, it's scary, and it causes a flash dip in the market. But the water damage, that is the creeping cost of energy inputs that just rots away profit margins slowly over time.
That is a perfect way to conceptualize it. The water damage is what destroys the foundation of a company's valuation.
Yeah.
And the market is reacting to who is holding the hose right now. Actions dictate supply chains. Rhetoric just dictates news cycles. So the markets are seemingly prioritizing Iran's pragmatic logistical steps over U.S. President Trump's rhetoric.
Wait, really? The market is ignoring the rhetoric?
Mostly, yeah. I mean, Trump is making aggressive statements, but the market is looking squarely at Iran, preparing for post-withdrawal state building.
Ah, right. And the most crucial action there is Iran introducing de facto tolls in the Strait of Hormuz. I mean, think about the mechanics of that for a second. This isn't just a political statement.
Not at all.
If you are a shipping company carrying oil to Tokyo, you now have to factor in the literal cost of safe passage or, the massive insurance premiums to risk going without paying it. It instantly changes the math for every single barrel of oil.
Exactly. Iran is officially maintaining this stance of resistance on the world stage,
Yeah.
but their physical actions, like negotiating safe passage individually with concerned nations, while instituting these tolls, it shows a highly pragmatic approach.
Right. They are monetizing and controlling a vital global artery.
Yes, and the globe is responding to the math, not the politics. We now have a 40-country coalition, spearheaded by the UK and including France and Japan, demanding the Strait of Hormuz remain open and free of these tolls.
Which brings us to a massive looming catalyst. President Trump has repeatedly delayed his deadline to halt attacks on Iranian power plants, but the new hard deadline is set for April 6th at 8:00 a.m. Eastern Standard Time.
Right.
And for those of you tracking locally, that is April 7th at 9:00 a.m. Japan Standard Time.
And while that deadline is fluid because the market knows Trump's positions can pivot rapidly, it matters acutely for Japan right now
Yeah.
because of the calendar.
Yeah, the late April earnings.
Exactly. Late April is when we see the full-year earnings announcements for March-end companies.
And this is where that guidance risk we always hear about comes into play, right? I want to make sure we clearly explain the mechanics here for you listening. When a Japanese manufacturer reports earnings, they don't just report what they made last year. They have to give guidance, which is a projection of what they will make next year.
Precisely. The stock price is largely based on that forward-looking guidance. But how do you project your future profits when you don't know the baseline cost of your energy inputs?
You don't.
Right. Or the stability of your shipping lanes because of a geopolitical standoff. You basically have to guess, and capital markets completely despise guessing.
It puts an immense, almost unfair amount of pressure on the Takaichi administration. I mean, the expectations from the domestic market are just huge.
Well, massive.
The administration has to navigate this multi-front policy war. They are expected to use diplomatic negotiations, strategically tap into national oil reserves, scramble for alternative procurement sources to bypass the strait entirely, and potentially deploy massive fiscal stimulus just to cushion the domestic blow.
It is a monumental task. And because of this profound structural uncertainty, SBI Securities set the Nikkei's expected range for the week incredibly wide.
How wide are we talking?
50,500 to 54,500 yen. Yeah, that 4,000 yen spread is a visual representation of market fear. And it hinges heavily on another massive factor, which is the creeping fear of stagflation in the U.S.
Oh, stagflation. That is the worst-case scenario.
It really is. If U.S. economic growth slows down but oil prices drive inflation up, you get stagflation. It's a toxic combination for equities because central banks can't lower rates to spur growth without making inflation worse.
Which perfectly transitions us into Section 2, which is key factors in Forex, because all these economic anxieties, the stagflation fears, the geopolitical catalysts, they are creating massive opposing tidal forces in the currency market.
Yeah, it's violent out there.
Very much so. We are looking at a violent tug-of-war for the U.S. dollar-yen pair, with an expected range of 156.00 to 161.00.
It is a fascinating mechanical struggle. Let's look at the downward pressures on the dollar first, because basically the force is trying to push the yen up. Earlier in the week, we saw direct verbal interventions. Vice Minister of Finance Atsushi Mimura warned that resolute measures are needed soon. We also had Finance Minister Satsuki Katayama making statements explicitly designed to check the yen's depreciation.
Okay, let me stop you right there and just push back on this because I always find this fascinating. Verbal interventions from Japanese officials are one thing.
Sure.
They say resolute measures, algorithmic trading bots, parse the headline, and the market blinks for a second, pushing the yen up.
Right.
But can they really hold the line if the fundamental U.S. economic data stays hot? I mean, it feels like standing on the beach and yelling at the tide to stop.
It's a highly accurate critique. Verbal intervention is a psychological speed bump. It's not a brick wall.
Right.
You cannot talk down a currency for long if the fundamental economic data demands that it be strong. And the U.S. data has been remarkably resilient. This is the upward pressure on the dollar. We saw U.S. retail sales and the ISM manufacturing index completely beat market expectations.
Yeah, they were super hot.
Exactly. Plus, Trump came out later and threatened stronger military action in 2 to 3 weeks. That instantly spiked geopolitical tensions, driving investors right back into the safety of the U.S. dollar.
Okay, so we have Tokyo trying to talk the yen up, and U.S. consumer spending and safe haven flows pushing the dollar up. Where is the tiebreaker in this tug-of-war?
The ultimate tiebreaker is the U.S. March employment statistics.
Ah.
Yeah. February was dismal. The The non-farm payrolls vastly underperformed, which weakened the dollar. The market is expecting a rebound this week specifically, a forecast of an increase of 65,000 jobs.
Wait, why that specific number? What is the psychology behind 65,000?
Well, 65,000 is the psychological threshold between a soft landing and stagflation.
Oh, I
Yeah,
see.
if they hit that number, it shows the U.S. economy is still churning out jobs, meaning it can handle higher interest rates.
Right.
It basically kills the stagflation narrative.
Ah, okay. So if that rebound is strong, if it blows past the 65,000 expectation, it will completely bulldoze Japan's verbal interventions.
Without a doubt.
Human traders and algorithms alike will buy the dollar, and we could see it plunge right back into the 160 yen range. I guess the data always overrides the rhetoric.
Precisely. But if the jobs data misses again, the technical floor we are watching is the 25-day moving average. Mechanically, this is just the average price over the last 25 trading sessions, and it often acts as a psychological support level for traders.
And where is that sitting right now?
Right now, it sits around that 156.00 yen mark.
Man, it is going to be a volatile ride, which is exactly why knowing exactly when these data points hit the wire and how they interact with each other is critical.
Absolutely.
So let's move to section 3, the weekly timetable. We have mapped out the macro forces. Now let's look at the schedule. But instead of just reading Monday through Friday like a table of contents, let's group these events by the thematic forces colliding this week.
I agree. That's a much better way to digest it. Let's start with the first major theme, which is the macro triggers. These are the events that will dictate global sentiment, regardless of what individual companies are doing.
Right. And the biggest macro trigger actually happens on Monday. It is a uniquely quiet start globally, honestly. Markets in Europe, China, Taiwan, and Hong Kong are all closed.
Yeah, it feels quiet.
But under the surface, this is the exact day of that massive U.S.-Iran energy attack deadline we discussed earlier, 8 p.m. Eastern Time.
Exactly. While equity floors are quiet, the commodity markets will be hyper-focused on whether that deadline passes quietly or with, actual military action. Another crucial macro trigger hits on Wednesday.
Which one is that?
The FOMC minutes from their March 17th and 18th meeting. These drop early Thursday morning Japan time, around 3:00 a.m.
Wait, why do meeting minutes from weeks ago matter so much right now?
Well, it goes back to the stagflation fears we just discussed. The market desperately needs to understand the nuance of the Federal Reserve's rate path. Are they privately more worried about inflation from these Middle East oil shocks? Or are they more worried about the U.S. economy actually slowing down?
I see. So it's about the internal debate.
Yes. The minutes reveal that internal debate, giving institutions a roadmap for future rate cuts or hikes. Later in the week, the U.S. also releases its PCE data, personal consumption expenditures, which is the Fed's preferred inflation gauge, along with its Q4 GDP revision.
That sets up our second theme perfectly, which is the Japanese domestic health check. We know the global winds are fierce, but how is the Japanese economy actually holding up internally?
We get a very clear picture of that starting Tuesday. Japan releases household spending data and the coincident index.
Right, and the coincident index is essentially a real-time thermometer for the Japanese economy. It combines metrics like factory output and retail sales to tell us exactly where we are in the business cycle today.
Exactly. And Thursday is the real crucible for the domestic consumer. We get the March consumer confidence data, but more importantly, we have a barrage of major retail earnings.
Huge ones. Fast Retailing, Aeon, 7 & I Holdings, and Tsuruha Holdings are all reporting.
This is critical. Fast Retailing and Aeon are massive bellwethers for Japanese consumer spending. If their guidance is weak-like, if they signal that Japanese consumers are closing their wallets because of inflation, it will send a chill through the entire Nikkei.
Oh, absolutely. Furthermore, we have 3 IPOs hitting the market this week: Systemexi, Hito Holdings, and Softex.
Yeah, I always find IPOs fascinating during weeks like this.
Same. I always look at IPOs during a volatile week as a fascinating psychological test. Launching an initial public offering when the market is worried about Middle East conflict and U.S. stagflation is just incredibly risky.
It really is.
It tests the market's true appetite for risk and liquidity.
Precisely. If those IPOs succeed, it shows there is still underlying cash looking for growth. But if they fail to launch or immediately drop, it shows institutions are hoarding cash and moving to safety. We also see a 30-year and a 5-year JGB auction Japanese government bonds.
Right.
This will test how much yield investors demand to hold Japanese debt right now, especially after the BOJ's recent hawkish minutes.
That brings us to our third theme, which all culminates on Friday, the global inflation pulse and technical volatility. Friday is an absolute gauntlet.
A gauntlet is the perfect word.
Right. Domestically, we have the Corporate Goods Price Index, or CGPI, hitting right before the market opens.
And we need to explain why CGPI is so vital right now.
Yeah, definitely.
Unlike the Consumer Price Index, which measures what you and I pay at the store, the CGPI measures wholesale inflation, basically what companies pay for raw materials. If the CGPI goes up, but Thursday's consumer confidence data goes down, that means companies are paying more to make products, but they can't pass those costs on to struggling consumers.
They literally have to eat the cost.
Yes.
That is textbook margin compression. And to add fuel to the fire, Friday is also options SQ. Let's unpack the mechanics of that because it's important.
Please do.
Special quotation days mean institutional investors who hold massive derivative contracts like index futures and options are forced to either roll them over or close them out simultaneously.
Just forced trading.
Exactly. It creates massive forced volume spikes that have absolutely nothing to do with economic fundamentals, but they can easily trigger algorithmic stop losses.
It injects pure mechanical volatility into the market open, and amidst that volatility, we get earnings from Yaskawa Electric and Ryan Kaikaku.
Right.
Yaskawa is particularly important. They're a massive bellwether for global factory automation. If their guidance is weak, it tells us that factories worldwide are pausing their capital expenditures.
Which ties perfectly into the data dropping shortly after. China releases its own CPI and PPI, the Producer Price Index. If Yaskawa says factories aren't buying robots and China's factory gate prices are dropping, it paints a very grim picture for regional Asian growth.
Exactly. And then Friday night, the U.S. is supposed to drop its own CPI data, followed by the Michigan Consumer Sentiment Index.
Wait, you said supposed to?
Yeah, I say supposed to because we need to address the massive overriding caveat listed in the source data.
Yes. I am looking at this critical footnote right now. It reads, the U.S. economic indicators might be delayed due to the government shutdown.
Yeah.
We have talked about all this data, the 65,000 jobs number, the PCE, the CPI, but a U.S. government shutdown means the agencies that compile this data, like the Bureau of Labor Statistics, are operating with skeleton crews. Or, not operating at all.
This is the ultimate curveball.
Yeah.
I mean, think about how modern markets work. High-frequency trading algorithms are programmed to scrape that BLS data the millisecond it is published, instantly adjusting the value of the dollar and U.S. equities.
Right.
If that data is delayed or released with a note saying it has low statistical confidence due to collection issues, you create a data vacuum.
And algorithms do not know how to trade a vacuum.
They don't. When the primary gold standard data is missing, institutions are forced to trade on shadow metrics.
What are shadow metrics?
Secondary, less reliable data sources. Things like private credit card spending or the ADP payroll report. It drastically increases the margin of error, which drastically increases volatility. The massive Forex tug-of-war we discussed. It might end up being thought completely in the dark if these U.S. numbers do not print on schedule.
It completely changes the complexion of the week. You are essentially forcing the most sophisticated financial market in the world to trade on geopolitical rumors and secondary proxy data rather than hard, verified economic facts.
Which circles us right back to where we started this entire conversation. Think about those Japanese corporate executives again.
Oh, yeah, the CFOs.
Right. Late April is rapidly approaching. They legally have to issue their earnings guidance for the next fiscal year.
They are staring down the barrel of that guidance risk.
Consider the environment they are forced to do this in. You have extreme unpredictability in the U.S. data schedule due to a government shutdown. You have fluid de facto tolls being applied to shipping lanes in the Strait of Hormuz, completely obscuring baseline energy and logistics costs. Plus, you have a domestic consumer whose confidence is being squeezed by inflation.
Yeah.
How can Japanese corporations possibly provide accurate, optimistic earnings guidance under these cascading conditions?
They can't. They just can't. I mean, if you are a CFO, your primary job is risk management. You are not going to promise the moon when you can't even see the sky.
Precisely. Which leaves us with a final crucial thread for you to monitor over the next few weeks. Will we see a massive wave of ultra-conservative forecasts from Japanese companies?
That is the real water damage spreading through the foundation of the market. It is not just the immediate shock of the geopolitical headlines. It is the conservative retraction of capital and expectations that inevitably follows. If every major firm lowers their profit bar to protect themselves from this uncertainty, the entire Japanese equity market suddenly looks overvalued. That is a huge structural question for anyone invested in this space to think about as we head into earnings season. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.